Peer-to-peer lending platforms are capable of delivering returns between 14 and 16%, much higher than what other debt products available to retail investors can do. But these are not another form of fixed deposits. They carry much higher risk. Before you invest on a platform, study its gross NPA. Look up the credit profile of the borrowers on that platform and also understand the average credit score of the borrower cohort that you are offered. This is advice from Neha Juneja, Chief Executive Officer, India P2P, in an interaction with Business Standard. Do watch this interview for an in-depth understanding of how these platforms work. Good afternoon and welcome to our show.
Thank you so much, Sanjay. Very happy to be here.
Thank you for agreeing to do this interview. I'm so looking forward on behalf of our viewers to learn about the workings of a P2P platform. My first question is simple and broad-based. Could you tell us how a P2P platform works?
So Sanjay, we are all familiar with the concept of lending to our friends, families, or even colleagues, where we give somebody a loan and they pay back with or without interest, as the case might be. P2P lending or peer-to-peer lending is a way for our regulator, the Reserve Bank of India, to formalize this practice so that now you can go on and lend capital to strangers as well, or individuals you don't know. So how a platform works is that, of course, a platform is an intermediary that provides the service of connecting potential borrowers in need of capital and investors who have excess capital and would like to lend it onwards at a return. So operate as a marketplace while also performing underwriting and due diligence on the borrowers. So doing a credit assessment check, is doing other forms of checks to assess the risk profile of the borrower and the validity of the borrower as well, and then enable matchmaking between the two to set interest rates, and also give doing the risk assessment also gives some indicative risk pricing or interest rate on the borrowers, and which is which in a sense is what a P2P platform does.
So what are the advantages of using a P2P platform? There are so many other fixed income instruments that are available to a retail investor. Say you have bank fixed deposits, you have small savings schemes, you have company fixed deposits, NCDs. So why then lend money on a P2P platform?
So there are fundamentally, if you look at the entire fixed income space in India, India is a let's say you buy an NCD of a microfinance company. Let's say you go out and buy an NCD of a large wholesale microfinance lender. I will not take names here. You will earn about 9 to 10% yield on that debenture or bond, whatever the instrument might be. However, India is a high interest rate economy. The borrowers eventually on the other side pay much higher interest rates. This bond might be, the capital will eventually flow into borrowers who will pay 22% interest cost. Peer-to-peer lending is essentially a technology platform which disintermediates these financial intermediaries who act as capital bulk breakers, who are not eventual lenders to the borrowers, but maybe lending to a smaller NBFC and further to the borrowers. By doing so, you unlock a much higher yield. So you can now potentially earn 16, 18%. I mean, those are very high returns, but let's say you can earn 14, 15, 16% simply by bypassing capital distribution intermediaries. And this is not to say that it's without risk. Of course, there are a different set of risks that exist in peer-to-peer lending. My general advice is that if you are invested in fixed income instruments or debt products in general, you should diversify across available debt products too. But having said that, for good diversification and to enjoy higher yields, you should have some part of your portfolio towards peer-to-peer lending as well.
So the primary benefit is higher rate of interest. Now, how does
yes,
one...
and then I'll just like to clarify that the higher rate of interest is not coming because of higher risk. It's not like platforms or even us, we're chasing, new to credit borrowers or very bad credit borrowers. By and large, I can speak for ourselves. Our borrowers on average have a CIBIL score of 712. And we are still able to deliver 16% yields to our investors. And that's because we are bypassing these intermediaries. And what is very interesting is that in peer-to-peer lending, the borrowers on the other side are retail borrowers. These are not institutions that are borrowing. And retail borrowers typically pay the highest. It's where the kind of buck stops. They are the ones who pay the highest interest rate. And with the platform approach, you can reach out to the borrowers directly and hence deliver these higher yields, not necessarily by taking higher risk.
So the advantage to the lender essentially comes from bypassing the intermediaries.
Yes, exactly.
What kind of a KYC procedure does one have to undergo to onboard these platforms?
There is no demat account needed because this is a debt product. But after uh, minus that, the KYC process is quite standard that you would do on any stock broking platform or otherwise. You have to be an Indian national. You have to be above 18 years of age and present with us your some KYC document, bank account verification, because capital flows can only happen through a registered, validated bank account, and just simple identity KYC, and very standard across all, which you have across other investment products as well. For borrowers, of course, the KYC and there's a further due diligence. So the process is more elaborate. There's a business check, bank account statement, and thereabouts.
Now, there are so many P2P platforms. How does one choose? How does one differentiate between them?
So there are a fair number of platforms out there, and I would say that as a retail investor, one is that do not invest in P2P lending without fully understanding what peer-to-peer lending is. I have seen misconceptions where people think, oh, it's a high interest FD. It is not an FD. It is still a product that entails risk, entails you to take risk. And one of the ways to diligence a platform is to check past performance. All platforms are obligated to present what their NPAs have been since inception or thereabouts, to check like how you check a mutual fund's past performance, and you base some of your decision making basis past performance. And of course, like similarly in a P2P platform, look at past performance and also understand what is the borrower segment being onboarded. Most platforms tend to focus on certain types of borrower segments because you can underwrite those borrower segments with a focus. It's important to see whether whether your capital is going towards loans to merchants. In some cases, let's say to women borrowers. In some cases, towards BNPL loans, or the use case further on, because different borrower categories do tend to have different default profiles. And by and large, if you're investing on a P2P platform, it's very important to know the borrower profile and potential default cases there.
So what is the figure that one looks up for to know the default rate? And how much, say, is your default rate?
Sanjay, so the figure to look up for a platform's default rate is the gross NPA number. I would, sometimes people do a little hanky-panky in terms of presenting a adjusted net NPA number. I always tell investors that look at the gross NPA, what the overall NPAs have been, which is one. Across different borrower categories, you can you can go to these credit bureau websites that update data that the chance of default for somebody with a credit score between so and so much is this much, and that's a fair enough assumption to keep in our minds when we are investing across P2P lending platforms. Our gross NPAs are just 0.01% because we only lend or predominantly lend to women borrowers who already have a good CIBIL score. And there is, I can talk very long about that, but I will not. But there is a big opportunity gap in terms of lending to women in India. Women have higher CIBIL scores than men in India, which is unique globally. This is not the trend, and yet 2.5 times less likely to get a loan for everything else being the same. So that is another matter altogether.
So let us talk a little about the risk profile of borrowers. You said your platform lends primarily to women borrowers. Could you tell us a little more about the kind of borrowers that you lend to and how that reduces the risk for the lender?
Yes,
Could you talk a little more about the profile of your borrowers?
So our Sanjay, so in India P2P's case, our borrowers are predominantly women. So like 95, 97% women borrowers. And all of these borrowers are small business owners. So they're not, these businesses would, let's say, be sub 7-8 lakh in income every year. So these are not big businesses, but very healthy small businesses. And on average, India P2P is the second or the third loan this borrower is taking for her same business. It's not because it's not the first loan. So she already has a good CIBIL score, which has been built on the income that she's been generating from the same business. The reason we are competitive, even at delivering even after delivering high returns to our investors, is because most lenders don't focus on women. So sometimes the same lady might have received a loan from a large corporate bank, but they don't come to offer her another loan sometime later. Just and because of that kind of service level gap is how we are able to get in and offer loans to these high credibility borrowers. And we also meet every borrower in person because these businesses are small businesses. It's very hard to underwrite the business by just checking data available in tax records, etc. So we actually send one of our field agents to go to each person's place or borrower's place of work and understand what the business is about and collect necessary data there.
So when one invests in a bond, one can look up the ratings of the bond. One can also look up the financials. So what are some of the criteria one focuses on when lending on a P2P platform? One, you said the gross NPA. Second, you said the risk profile of borrowers. Is there anything else?
There is actually not much else, Sanjay, except for the fact that one should be conscious of the borrower category and the overall profile of the borrower category. So let's say if you're lending to MSMEs of a certain scale, one needs to see how what are generally the default rates of these kinds of MSMEs, have some understanding of that gross data and how that has changed over the past few years. That does become important. But yes, P2P platforms cannot go out and get rated because ratings are specific to institutions who are building their own books. A P2P platform is not building its own book, so the platform can't get rated. And but like a mutual fund, it just becomes important to track past performance and kind of the overall sectoral profile.
Can I choose the risk profile of the borrowers? Like on a particular platform, can I choose among different sets of borrowers? Or when I go to a particular platform, there is a certain set of borrowers and I have no choice in that matter. How do things play out?
So you can choose the risk profile of the borrower, and you can choose like a higher risk, higher potential reward borrower versus a lower risk, potentially lower reward borrower. That is certainly possible because borrowers on the other side, like I said, are retail borrowers. So you have a big mix out there. But it becomes very difficult. It's a practical problem for an investor who comes on the platform to, just understand each and every borrower profile and allocate. Ideally what you should do is that if you're investing 50,000 rupees, you should split that 50,000 rupees into 50 loans or 100 loans, whichever way, to diversify your risk as finely as possible, within, of course, a risk band that you decide to set for yourself. But that's a lot of cognitive load on an investor who comes on the platform, which is why most platforms actually give you a ready-made cohort of borrowers, telling you that like in our case, you can choose borrowers or you can choose a ready-made cohort, where we'll create a diversified cohort, ensuring that there is no concentration of your investment across any geography, any specific type of business, etc., etc. Because technology is like a great power here. Splitting a 50,000 rupee investment into chunks of 500 and collecting that repayments, aggregating and giving it back to you has no cost. Once a technology stack is built out, it's zero cost thereafter. And that's what most platforms do. But having said that, if you feel that you have the time and the ability to diligence each profile, yes, that's also possible
So
to create your own.
the work of diversifying the loan is essentially done by the platform. The retail lender doesn't really have to worry about that kind of stuff?
Retail investor doesn't have to worry about, and there are some retail investors who may come from financial services and are savvy enough to understand and create a profile, and they're also free to do that.
So the profile of borrowers is available on the platform.
Yes, the profile of borrowers is indeed available, but it's very difficult to make available all the information you have on the borrower without violating any privacy norms or other things. So so you do have to, at some level, trust the platform's credibility and rating and some other manufactured parameters to underwrite the borrower or diligence the borrower if you're doing it on your own.
The next point I wanted to understand is how liquid are these investments? Like normally say you break a fixed deposit, you pay a certain fee, and then you can pull your money out. What happens on a P2P platform? Can I pull my investment out midway?
So Sanjay, it is there are platforms that offer instant withdrawals also. So you can put in money today and withdraw tomorrow. We don't do that, and then there are some platforms that have hard lock-ins. So we have a 12-month hard lock-in because, and I'll tell you there's definitely an advantage to having these instantaneous liquidity. There is also a potential disadvantage if an adverse event comes across. Now, what happens is that your capital has gone into loans. The platform on its own has no liquidity reserves. The regulator does not allow a platform to have any liquidity reserve to instantly process withdrawals. Platform is only a technology layer in between, a regulated layer, but a technology layer. So your capital is in loans, and until the borrower doesn't pay back their principal and interest, there is no way without this liquidity to process your withdrawal if it happens. The only way to do it is to have a secondary market for your portfolio, which also comes with its own level of uncertainty. If things are fine and let's say a few people need withdrawals for emergencies, premature withdrawals for emergencies or thereabouts, yes, you can, even on India P2P, pay a few percent like a exit fee and exit. But we cannot promise that, because let's say everybody wants a withdrawal, withdrawals will not happen. They will only happen once the lock-in expires, once the funds are recovered from the borrowers.
So how
So I mean,
long
it depends on loan tenure, Sanjay. So some loans can be, some platforms can give out loans for just 3 months. So you have like a quicker, recycling of capital there. In the regulator allows loans up to 36 months, but most loans are, thereabouts 1 year or thereabouts. But having said so, I would still really urge retail investors not to see this as a liquid product, because it is fundamentally not a liquid product. It is, and most platforms are still growing. They're not, we're not in steady state yet. So it should definitely not be seen as a liquid instrument.
how long a track record do P2P platforms in India have? Like you said,
So
one should look up the performance of portfolios, but that number will only make sense if the platforms have a long enough track record.
Yes, Sanjay. So we might be the one with the shortest track record, which would be just about a year and a half. But peer-to-peer lending platforms started even prior to the regulations that came in. So you'll have some platforms who've been operating from 2015 and thereabouts. And of course, the regulations came in 2017, 18. It took some time for platforms to kind of adopt the new regulations. So you do have it more than a few years of track record across most platforms, barring us, incidentally. We are the youngest, but and that's good enough. And that track record also captures COVID, which has been a highly distressing period for the entire, everybody for that matter. So you will see you can also see the worst case scenario, and then kind of the better, slightly better scenarios after.
In your case, was there a spike in default rates during COVID?
We were not operating during default, so we kind of started operations well after the second wave had passed. So in our case, that was not the case, but I can speak for the kind of women microfinance industry during that same time, defaults did spike. So defaults did go up to about 4%, 4.5% thereabout levels during COVID. And I mean, some of those NPAs are still being settled off the books of various NBFCs. So if an event like default happens, it is indeed, you can be very well diversified and all that, but you will still see some impact on your investment. But the good thing about diversifying well is that even if you have, let's say, a 5% default and a platform is offering you 15% returns, if the diversification is ideal, you will earn 8 9% in that bad year as opposed to 15%, which is the power of technology here, because your money is so finely spread across, which is what makes it interesting. But there will definitely be an impact, and that's an impact you don't have in FDs or otherwise, so it should not. That's where the high risk, high return difference comes.
Can you give us a sense of how these platforms are regulated? What is the
Yeah.
regulatory framework?
Yes. So before a platform can even begin operations, the platform needs a certification from the Reserve Bank of India. RBI is the regulator for all peer-to-peer lending platforms. In fact, the regulatory terminology of peer-to-peer lending is peer-to-peer NBFC or NBFC peer-to-peer. So they come under the we are governed under the ambit of broader ambit of NBFCs, but within that, the peer-to-peer category of NBFCs. So you first need to park some capital with the Reserve Bank of India, show a certain net worth rather, and go through the certification process. Then there is an IT audit on your processes to ensure that these are purely tech platforms. So the RBI is very cautious about ensuring that the tech is also not, there's no naughtiness in the tech to ensure that uh, capital is secure. And I would say that the regulator has very granularly defined this regulation very well. It's a very neatly defined regulation because there's a lot of focus on protecting retail investor interest. These are one of those few regulatory frameworks where a technology platform can access capital from the retail investors directly. And so the regulation is very granular, and it's also very well thought out in terms of how fund flows work. So all fund flows work through escrow mechanism, mandatorily through escrow mechanism. So the platform, like as we cannot, if you are an investor on the platform, I can't touch your capital. You know, it's not sitting in an India P2P current account or anything like that. And all capital flows are monitored by an IDB, an RBI endorsed trustee. So we send fund transfer instructions to the trustee. Trustee then moves money from escrow to escrow, and that's how the fund flow works. So it's very sophisticated. It's quite advanced, I would say, and neatly regulated as well by the RBI. So there's no other regulatory body involved here.
Now, could you offer some advice to retail investors who choose to lend on a P2P platform? How should they go
So
about it? What are some of the do's and don'ts?
So my first advice would be to, sometimes people just get very excited by high returns and will park a lot of capital. Do not do that. Please, it's important to test out a platform, diligence a platform, diligence the overall concept as well, and only then start. And I understand that most retail investors don't have any time to diligence, because you will just rely on something that your friend or your colleague or somebody at the office was talking about. So to counter that behavioral thing, the advice would be to start small. Maybe start with a much smaller investment, maybe just 5 10,000 rupees. It doesn't matter. See what the check your portfolio 2 months, 3 months down the line, and then top up as you feel comfortable. Start an SIB type investment if you feel comfortable. But it's quite all right to start small, because that's a great way to learn about this investment product, and then start big. And most importantly, every retail investor should think in terms of an overall portfolio. You can have one thing in your portfolio that can give you 15% returns, but you should also have something in your portfolio that can potentially give you lesser returns, but at a potentially much lesser risk also. So mix debt, equity, spread. I mean, there's plenty of that advice out all there, but On peer-to-peer lending, because you can make small investments, the best advice is to start small, learn, and then scale.
And how often does the interest payout happen? Does it happen every quarter, every 6 months, or 1 year?
So, Sanjay, these are mostly retail borrowers on the other side. So, most loans are EMI based loans. So, interest payouts are monthly. And investors on the platform would also receive interest payouts as they are received from the borrowers, which is monthly.